Welcome to this week's Simple Market Update. I'm Jason Hamilton, the founder of Keep It Simple Financial Planning, and in this video we'll discuss recent stock market swings and how the unwinding of the carry trade in Japan may have worsened the fragility of global markets. Markets recently experienced a spike in global uncertainty with the VIX, a measure of volatility in the stock market, reaching a level not seen since the pandemic. This was due to concerns around U.S. economic growth, Fed rate cuts, and tech earnings. However, it may have also been worsened by the unwinding of the Japanese carry trade. What is a carry trade and how is that linked to global stock markets? Let's talk about it. While it may seem complex, the concept of a carry trade is actually quite easy to understand. A carry trade simply involves borrowing at a lower interest rate and investing at a higher interest rate, thereby earning the difference in yields. So simply put, a lot of people right now have their mortgages at 3% or 4%. But they may have other money that's invested or in a savings account at 5%. So by getting the 5% in their savings account and paying their mortgage at 3%, they're taking out the middle there and they're keeping that as part of their investment return. Very similar concept. So this also requires buying and selling currencies since investors will often utilize government bonds around the world. In general, carry trades are more attractive when there is a large difference in interest rates and when currencies are stable. So this chart shows the yield on a 10-year U.S. Treasury bond and the equivalent yield on a 10-year Japanese government bond, with the shaded blue area representing the spread between them. It shows that the spread has historically been large, presenting an opportunity for investors to earn strong returns through carry trades. However, Japan recently started to raise interest rates as the Fed is expected to begin cutting rates as soon as next month. In anticipation of this spread narrowing, traders began unwinding their positions, causing a drop in Japanese and global stock markets as volatility increased. Next, this chart tracks major global currencies over the past 24 months with the value of each currency re-indexed to 100 at the start of the period. The number at the end of the series shows the non-re-indexed value. As you can see, many of these currencies have experienced volatility over this period, but none more so than the Japanese yen this past week. When the Bank of Japan raised rates while economic data indicated that the Fed would soon lower its rates, the relative value of the yen shot up. The carry trade, which involves borrowing in currencies from countries with low interest rates, in this case Japan, and investing in higher yield assets, unwound rapidly, sending shockwaves across global markets last week. However, the situation has since stabilized and the yen is beginning to trend back closer to the previous levels. Finally, this chart shows stock market corrections and recoveries going back to World War II. Market corrections are defined as declines beyond 10%, but no more than 20% from the most recent all-time high. In the average correction over this period, the S&P 500 fell 14.3% from peak to trough over the course of about 5 months. Recoveries typically occur more quickly, taking just 4 months on average. Most importantly, these recoveries tend to begin when investors least expect them. In light of recent technical factors driving markets, it's crucial for investors to remember that in the long run, markets are driven by economic growth and corporate earnings. These fundamental factors tend to propel markets higher over time despite periodic setbacks. Despite recent market swings, staying invested is essential to staying on track towards financial goals. We hope you found these insights on recent market moves valuable. If you have any questions, please don't hesitate to reach out. We look forward to speaking with you soon.